Welcome to China Perspectives, a podcast on economic and credit developments in China, featuring experts from within and outside of Fitch Ratings. My name is Jeremy Zook, lead China sovereign analyst at Fitch Ratings and co-host of this podcast. In today's episode, we plan to dig into the implications of the rise in U.S. tariffs on China, a topic that is top of mind for investors and China watchers. The situation continues to evolve rapidly, but since taking office just over a month ago, U.S. President Donald Trump has threatened to impose a slew of tariffs on a broad range of U.S. trading partners. Tariff increases on Canada and Mexico have received a high degree of attention, but China has remained front and center in U.S. tariff actions. The Trump administration has so far imposed a cumulative 20% across-the-board tariff increase on Chinese exports to the U.S., above already existing tariff rates. These hikes came in two separate actions, raising tariffs by 10% across the board in both early February and early March. Further tariff actions on China appear to remain under discussion. For its part, China has responded with targeted retaliation by raising tariffs on a number of U.S. goods, among other measures. In this episode, we'll discuss the potential impacts of further U.S. tariffs on China from both a macroeconomic and corporate level perspective, assessing the risk to China's economy and which corporate sectors are most exposed to tariff actions. Joining me today to discuss these issues are Alex Muscatelli and Janice Chong. Alex is an economist on Fitch's economics team covering China along with a number of other economies. Previously, he was on Fitch's sovereign ratings team, covering European sovereigns for a number of years. Janice is a group credit officer for Asia-Pacific corporates, a role that she has been in since 2021. Prior to that, she was a member of Fitch's corporate ratings groups, primarily focusing on the telecom sector in Asia-Pacific. Welcome, Alex and Janice. Thank you for joining us today.
Thanks, Jeremy.
Thanks, Jeremy.
Alex, I'd like to start with you to get Fitch's view on the macro impacts of potential tariffs. Clearly, still a high degree of uncertainty around the outlook for U.S. tariffs on China and that of tariffs more broadly. President Trump, as I mentioned earlier, has already imposed a total of 20% across-the-board tariffs on China since the start of his second term. Meanwhile, there seems to be a range of other global tariff measures and trade investigations in the works, including so-called reciprocal tariffs. What is Fitch's base case when it comes to U.S. trade tariffs on China?
Well, since the presidential election took place, we have assumed that U.S. trade policy would take a sharp protectionist turn, even with uncertainty about scale, scope, and timing of tariffs. In our December Global Economic Outlook, we assumed that the very high tariff rates for China that Trump spoke about during the election campaign, including announcements of tariffs of up to 60% on China, would apply to dutiable goods rather than all imports. Now, this would still translate to a sharp increase in the effective tariff rate of the US on China from around 10% to around 35%, which drives to a large extent the increase in the overall effective tariff rate for the US from 2.3% in 2023 to almost 8%. Now, the announcements that we had at the beginning of February, together with those coming into force on March the 4th, have taken the effective tariff rate on China to levels not far off our assumptions. We think this is consistent with the administration's view that tariffs are related to and can reduce trade deficits. And just a few days ago, the US administration published a memorandum outlining the intention of restricting US China investment flows if these are related to, among other things, technology, critical infrastructure, and energy. And this underlines further the adversarial stance that the administration is showing towards China.
Now, Fitch has done a lot of modeling of various tariff scenarios. How much of an economic growth impact does Fitch see coming from direct tariffs on China in our baseline, and then in a potential downside scenario where there's a sharper rise in tariffs? And then what about retaliation by China? What is Fitch's base case here?
Yes, we conducted simulations using the Oxford Economics Global Economic Model to assess the impact that our assumptions on tariffs that I spoke about earlier would have on the world economy. In a scenario consistent with our GEO assumptions, we estimated that the impact on the global economy would be a shortfall of zero point 0.4 percentage points in the level of output after 2 years, compared to a counterfactual scenario of no further increase in protectionism. Now, looking at China in particular, the impact would be bigger, given the relatively large increase in tariffs compared to other trading partners, and we estimate that this would be zero point 0.7 percentage points on the level of output. So it would be a substantial drag on the overall macroeconomic outlook for China. Now, how does the shock affect various components of demand? Well, the main hits would be to exports through lower US demand and also lower investment in China, while consumer spending would not be hit that much, and there would also be a substantial fall in imports, mitigating the fall in headline GDP. Regarding more severe scenarios, for example, a scenario where Trump's campaign announcements are actually translated to effective tariff rates, and so a 60% effective tariff rate on China, then the hit to both the Chinese and the global economies would be around 3 times as large. So 1.6 percentage points on the level of GDP for China and 1.2 for global output. Now, the scenarios I just talked about did not assume retaliation from China or indeed other trading partners. But with retaliation, you would have a bigger impact on the global economy through lower US exports and investment and also lower Chinese domestic demand. For example, you would have inflation a bit higher in the short run, which would dampen consumer spending. So retaliation makes things worse on aggregate, despite the obvious attraction of it for governments which are on the receiving end of tariff increases.
Thanks. Now, this isn't, of course, the first go around when it comes to tariff risks on China. Of course, during Trump's first term in office from 2017 to 2021, we did see certainly a rise in U.S. tariffs on China. And since then, China has taken a number of steps to insulate its economy from the effects of U.S. tariffs, including through things like trade diversification, which also includes a degree of trade diversion to simply get around U.S. tariffs, as well as enhancing domestic supply chains. Does Fitch think that these changes are likely to temper the impact of U.S. tariffs on China, say, compared to 2018?
Yes, absolutely. So we see in the data that US import shares have changed quite a bit since the trade war in Trump's first term, with the import share of Mexico and Vietnam rising steadily and that of China decreasing. So, in terms of final demand, these shifts will mitigate the impact of increased tariffs on China's GDP, as the hit to any country in our scenarios will depend on the increase in tariffs and the exposure to the US. And so the numbers I talked about earlier in terms of the scenarios would have been larger if the US import share for China had remained at the level seen before the trade war of 2018 2019. But of course, there are also indirect impacts on China through the supply chain and through lower demand for intermediate goods. So there would be still a considerable extent. I'm sure Janice will expand a bit on these topics.
So, putting, I guess, all of this together, how does Fitch see China's macro outlook for 2025 and 2026?
So we think that the downward pressure on external demand in China that we've discussed will be at least partly offset by a degree of policy stimulus and exchange rate depreciation, consistent with the policy announcements coming from China over the past few months. We expect interest rate cuts of 25 basis points this year, although the shift to a moderately loose policy stance in December increases the likelihood for rate cuts beyond our expectations. That said, we also think fiscal policy will be a key factor in supporting domestic demand and offsetting external headwinds. Monthly public finance data show that fiscal policy turned expansionary in the second half of last year, and we expect a substantial widening in the public deficit this year to around 8% of GDP. Our forecasts are for GDP growth to be 4.3% this year and 4% in 2026. In the context of still weak price pressures, low levels of consumer confidence, and a property sector that is showing some signs of stabilizing on some metrics but is still weak. At the same time, the outturn for the whole of 2024, and in particular the last quarter of last year, was stronger than we had expected, and this is an upside to our forecasts. One thing that we will have to assess in the coming weeks is to what extent the strong outturn for the fourth quarter was driven by firms and consumers outside China bringing forward demand ahead of prospective tariff increases. Turning finally to inflation, we see domestic price pressures remaining subdued. There will be some pickup in the inflation rate over the next 2 years, but we think inflation will remain below 1.5%.
Great. Many thanks for that, Alex. Janice, I want to turn to you now to discuss the impact of tariffs on specific corporate sectors in China. We'll start with which sectors does Fitch see as most exposed to potential risks from US tariffs?
Thanks, Jeremy. Among the most exposed sectors are technology hardware, automotive, and new energy manufacturing. Now let's start with technology hardware. Over 40% of US imports from China are in computers, electronics, and electrical equipment. While smartphones and computers have been largely exempted from the previous tariff rounds, any new tariffs could deliver a blow to Chinese exporters, reducing their competitiveness and complicating their pivot to other markets. Yet, despite these challenges, China remains a powerhouse in high-end manufacturing thanks to its complex supply chain and dominance in critical components. And then there is the automotive sector. China's direct exposure to the US market is relatively limited, but the ripple effects are significant. Trade diversion to other markets or towards domestic sales, as highlighted by Alex, could create waves, notably impacting investment plans. And let's not forget the 25% tariffs on imports from Mexico could hit Chinese auto parts suppliers operating there. Now, with respect to the new energy manufacturing, where solar and lithium-ion batteries take center stage, the US doesn't import many solar panels directly from China, but the Chinese manufacturers in Southeast Asia could find it tough to redirect their supply amid a global glut. Meanwhile, the impact on lithium-ion batteries is more moderate, as they don't face the same oversupply issues, and in fact, China controls a major portion of the global battery supply chain. And lastly, we touch on the chemical sector, which is moderately exposed to trade tensions. Potential tariffs could pose challenges here, with China's capacity to absorb additional supply likely to be hampered by weak domestic demand. However, China's key role in the global chemical supply chain makes it difficult for the US to quickly diversify its sources. So, for example, specialty chemical supply chains rely heavily on China as the sole supplier of key raw materials for active pharmaceutical ingredients.
You mentioned the 25% tariffs on Mexico. Chinese corporates have increasing export exposure to Mexico, especially in the auto sector, as you mentioned. What are the key risks for Chinese corporates from these tariffs on Mexico?
Well, Mexico has become a key hub for Chinese automakers looking to access the US market. And that's largely thanks to tariff exemptions under the US Mexico Canada Agreement, or also known as the USMCA. Tariffs on Mexico would hit Chinese auto and parts suppliers hard, with production plants in Mexico. Companies like Chery, SAIC Motor, also known for its MG brand, BYD, and Great Wall could see significant impact. Increasing regulatory uncertainties may deter and delay further Chinese investments in Mexico, potentially accelerating a shift in manufacturing to other regions like Europe and Latin America.
Now, the Trump administration has also recently raised tariffs on steel and aluminum imports, and auto tariffs do appear to be in the works. How much of an impact will those tariffs in particular have on Chinese steel, aluminum, and auto firms?
Yep, let's start with the steel and aluminium. The direct impact of US tariffs on these imports is expected to be limited. The US accounts for less than 1% of Chinese steel product exports and just 4% of China's aluminum exports. So China's aluminum production mostly serves its domestic needs. But here's where it gets interesting. The indirect rippling effects across global markets are much more concerning. Increased global competition could lead to demand shocks in downstream sectors like electronics and new energy, putting pressure on Chinese steel consumption. So as a result, we might see Chinese steel exports redirected to other markets, which could squeeze margins for domestic producers. Now, on top of this, countries like Vietnam and South Korea are already stepping up with their own trade protectionism measures, imposing anti-dumping tariffs to manage the excess supply of Chinese steel. Heightened trade competition might weigh down on global demand, affecting the long-term outlook for commodities like steel and aluminium. So Trump said that he may be considering similar tariffs on the auto imports. China's direct exposure to export is small, but once again, it's the wider implications on trade dynamics, market diversion, and increased global competition that we need to keep an eye on. So the potential auto tariffs could shake things up in ways we're just beginning to understand.
Yeah, these external challenges are certainly rising on quite a broad scale. How are Chinese corporates seeking to manage these tariff risks?
Well, to manage this risk, many Chinese companies are employing a few key strategies. First, they've been shifting production destined for the US market to other countries. Second, they've been seeking strategic partnerships and expanding their overseas supply chains to overcome trade barriers. Additionally, these companies are also working to diversify their markets, aiming to reduce their dependency on the US. However, it's important to note that the effectiveness of these strategies may be constrained by broader US tariff policy, which can still pose significant challenges.
One trend that we've seen over the past several years, which was perhaps sped up by the trade war during the first Trump term, is increasing outbound investment by Chinese firms. Will the tariff increases that we've just discussed, will that hasten the trend by Chinese corporates of shifting production to other countries? Or does the more global targeting of tariffs by the Trump administration this time around limit some of the benefits of such moves?
I think the tariff increases are likely to accelerate the trend of Chinese corporates moving production to countries like Vietnam, Indonesia, and India, which are already seeing a shift in manufacturing operations. However, the broader scope of the Trump administration tariffs could limit the benefits of these relocations, with tariffs targeting not only imports from China, but also from other countries like Mexico, potentially. Companies might find themselves facing new trade barriers regardless of where they shift production.
Great. Thank you very much for your time and insights today, Alex and Janice. As we've discussed, there is still a high degree of uncertainty around the path for U.S. tariffs on China, but you still, in our base case, anticipate further tariff hikes are in the pipeline, which will continue to weigh on China's economic outlook and impact a number of corporate sectors. I'm sure we'll all be very busy in the coming year responding to and analyzing the impacts of future U.S. tariff announcements on China. Fitch has already published a number of commentaries around tariff impacts, which can be found at fitchratings.com. And more work will be forthcoming as we continue to get greater clarity on U.S. trade policy. You've been listening to Fitch Ratings China Perspectives podcast. To learn more about our ratings and research on China, visit us at fitchratings.com. And please subscribe to our podcast on iTunes, Spotify, or wherever you get your podcast. Take care until next time.